Okay, guys, thanks for coming. We got a good crowd here in person. We're gonna have a sponsor come bring us lunch later. We're gonna stay around after and network a little bit. Ashley has this slide on here just to remind me to tell you why we do these trainings. I mean, we just want to give back to all agents and just give value. And our tag phrase is create a better agent experience, not just for our clients. You know, we want them to have a good experience, right? Come back to us, refer their friends and everything. But it's important as an industry and as agents that we give value to each other as well. And so we do these trainings and we invite people from all brokerages. Thank you guys on Zoom there that are joining us. Next time, feel free to come in person. We'd love to have you here. But yeah, we just want the whole industry to be uplifted and be better and to really, serve people, right? I say this a lot, but I think the whole industry would be better if we weren't sold as a sales industry, but more of a service industry, because we really are here to just serve our clients and do what's best for them. And it kind of takes away the closing and the sales and the scripts and the things that are front and center. In my opinion, this is my opinion, and I'm up here so I can say whatever I want. So, take it for what it is, but I really think if we focus on others first, we'd be successful. I mean, Lynn and I actually are testaments to that. We don't even do lead generation. We got a pretty good book of business and it's 100% referrals. So just love on people. And part of that is introducing you to amazing people. So Alan's going to be talking about what's going on in the market and what can we expect. And let's have a dialogue about the craziness. Is it crazy? And what kind of talking points can you take away from this to engage your clients and to talk to them about, because of, we don't know exactly what's going on. We need somebody that does all this research to share and distill it down for us so that then we can share it, right? So that's what I want you to do, is listen to this with the idea of sharing it with other people. If you're not doing the transactions you want, you're not having enough conversations. Alanblood is actually Shayna and James' preferred lender for years now. We've been working together.
Quite a few.
So
6 years.
6 years. So we get to meet.
That's like
people like
42
Alan.
years and dog years, the realtor years.
Right.
Yeah. So yeah, share your professionals with us and let us, more people should meet Alan, and that's why he's here.
Thanks, man.
Yeah, so
Thank you.
I'll give you a clicker and you can take it away.
I'll jump in. So I know some of you, us haven't met. Is this it? There we go. Okay, cool. So by way of background, my name is Alanblood. I'm a mortgage broker. I have been in the mortgage industry for 27 years. I've seen a lot of crazy stuff. I've done about just under 12,000 transactions. So I've seen a lot of weird things because I've done a lot of transactions in that time frame. I studied economics at BYU, and then I went to law school at the U, and I was a member of the Utah State Bar for 10 years until I woke up one day and I wondered why I was taking continuing education classes I was never going to use. So I stopped paying licensing fees and stopped going to CE classes and started doing more useful things with my time, like coming and helping people like you guys. So that's the background I bring into this. So my goal with this is that you guys can walk away with answers to these questions. Are you getting these questions a lot?
Mm-hmm.
So people ask what's going on with rates, where home prices heading. This is really what everybody wants to know, isn't it? Can I buy a house? Is now the time to do that? How many of you have had that question in the last month?
Mm-hmm.
Raise your hand. If you haven't had that question the last month, you should be hearing that question, because the only reason you're not hearing the question is if you're not talking to people, because everybody is asking this question. So it would be good to have some answers. And I think it'd be even better to have some answers with some knowledge and background behind this. I've had the chance to share this with a number of agent groups, and I've got some great feedback from people. An agent reached out to me after the last class that I did, said, hey, went to a listing appointment. I got the listing because I told them what you told us. And they said, you're educating us and everybody else is just telling us stuff. So hopefully that will have that impact for you guys and for those of you listening, and it'll give you some information that you can share in a more meaningful way. So you can answer this question with some knowledge behind it rather than just throwing a dart at the wall. Because doesn't it feel like that sometimes? We're just guessing. Well, the reality is I'm just going to guess here too, but at least I've got some basic, so let's talk about that. So 4 things that could bring interest rates down. Here they are. Number 1, if inflation gets in line with what the Fed is expecting, then they're going to start cutting the Fed funds rate. Number 2, there's a lot of pressure on the Fed Reserve to ease quantitative tightening. How many of you have heard of quantitative tightening? No one.
I've heard of it, but I couldn't explain.
How many of you have heard of quantitative easing? This is the reverse of that. But if you asked a group of consumers, it's going to be a 0% knowledge of what this is. This is the single most important thing driving interest rates. So if you can understand this, it's going to give you a lot of knowledge that you can use. Recession. Recessions are good for interest rates. Are recessions bad for home prices? Do home prices go down in recession? One time they did, that's it. Just one time, and that was the housing recession. That was a totally different set of factors. And we'll talk about the impact that that's had a little bit too. And then lastly, administrative intervention. I get this question all the time. FHFA, by the way, stands for the Federal Housing Finance Administration. So there's the FHFA, which is like a big umbrella. And underneath that, you've got Fannie Mae, Freddie Mac, FHA, VA, and the USDA arm is kind of sort of intermingled in there. So this is the overarching regulatory body for mortgage financing for most loans that are done in the United States. This sits under the umbrella of the US Treasury. Are they open to some political pressure? So there's going to be some things maybe that could cause rates to change because of that interaction there potentially. And we'll talk about those 4 things. All right, let's jump into inflation. So I just updated this after the January data, and this is an important chart to understand a little bit. So the Fed has said that their target for core inflation is 2%. They want inflation to be at 2% or less, and that's the point where they think we've hit the ideal place where we've got market stability. The Federal Reserve, their job is not to mess with our livelihoods, as crazy as that sounds. Their job is to maintain stable monetary supply and stable employment. Their job actually is not to maintain stable interest rates. Their job is to maintain stable monetary supply and stable employment, and they do that by using their available tools, one of which is their Fed funds interest rate. So when you hear about the Fed raising or lowering rates, they're not doing anything with mortgage rates. They're raising and lowering the rate that banks borrow from the Fed on overnight lending. Did any of you know that? Weird, right? You've heard it before. So they're not changing interest rates for consumers. They're changing overnight lending rates. And that has an impact through the market and eventually finds its way towards mortgage rates because they're impacted by the same thing. But just know so that the Fed is going to start tightening most likely when we hit about a 2% target. Based on where we were, this number is a little different than what you're going to see in the news. In the news, it includes housing. And the challenge with housing is they use a 12-month lag. So if you average the cost of housing over the last 12 months, is that going to be higher than the cost of housing today? Trick question. It will, because what were interest rates in October? Like almost 8%.
Yeah.
So the cost of housing 5 months ago is more than the cost of housing today just because of interest rates coming down. And prices have been relatively stable-ish, right? So when we're looking at inflation data and you see these headline numbers, that's taking into account this 12-month rolling average. So what I've done is I stripped that out and I put back in actual inflation costs for housing as they are and as they're predicted to be from some industry stuff. And this is what I came up with. We're probably going to hit that 2% number right around April. And the reason why that's important is the meeting that follows this data likely coming out is in June. So there's a pretty good chance based on this alone that the Fed is going to look at lowering their interest rate in June. And when that starts hitting the news and your clients hear, hey, the Federal Reserve is going to lower interest rates, what advice should you give them about locking in their rate? None. You're real estate agents. You shouldn't give advice about locking in their rate. The advice you should give them is talk to your lender and find out what this means for you specifically, right? Here's the reality of that. The majority of time when the Federal Reserve raises their interest rate, long-term rates go down and vice versa. So if they drop their rate, it oddly has this weird impact of raising rates for the short period of time. So it's kind of not what everybody thinks it would be. So you don't need to know that. What you need to know is when somebody says, well, what should I do about interest rates? What's your answer?
Call your lender.
Call your lender. That's a great, let's call them together. Let's find out. You don't have a lender? Great, I got one for you. So we'll probably start seeing that activity happen here, and that's important because this is a dramatic change from 15 days ago. This is another one you might not have seen before, the Federal Reserve dot plot. You guys have heard of the dot plot? So here's what this is. There's 19 members of the Federal Reserve Voting Board of Governors. 19 dots. So once a quarter, they update what their expectations are for the next 3 years plus longer run. So they all say, and this is anonymous, I think rates should stay the same this year, but next year I think we should be around here. And the following year around here, and then longer run around here. And this updates once a quarter. So it's kind of a little bit of a snapshot into what the people who are making this decision are thinking in advance. Does that make sense? Is this useful to know? If you look this up, you will find it. If you don't know that it exists, you'll never see it. So it's the Federal Reserve, the dot plot. And again, it comes out quarterly. So this was from December. So this tells you that as of December, none of the voting board of governors thought interest rates should go down. So shocker, they did not go down. But as we head here into 2023, there's a pretty good consensus that rates should be, so this is right here where we're at about 5.75. Rates should be somewhere around 4.75. And by 2025, the consensus is around 3.5. And by 2026, around 2.75, and by the longer run, around 2.5%. Now, this is the Fed funds rate. This is not mortgage rates, right? But where these rates go, mortgage rates tend to follow eventually. So this was January, this was December. But how often does these things change? This changes quarterly. Their expectation changes by the minute. So this is outdated the moment that it's published, but at least it gives you an idea of what they were thinking at that moment in time. And then you can look at what happens after that and gauge it against what they were expecting and kind of figure out, okay, what do we think the Fed's going to do from here? And that's what the market does. And they do that with the Fed funds futures market. So there's this whole market you can go in and you can look and you can see what are the odds of the Federal Reserve reducing their rates based on what people are buying and selling bonds for. And you can go ahead and actually go find these numbers too if you Google for them. Wall Street Journal usually publishes these. So here's where this is important. As of January 15th, there was a 50% or 56% likelihood in the market expectation that the Fed was going to reduce their interest rates in May. 68% they reduced it in March. So that was what we thought on January 15th. And then the Federal Chairman Jerome Powell went on 60 Minutes on Sunday night. And on 60 Minutes, he basically undid everything they did in their meeting on Wednesday. And you can go watch it if you want to just sit there and see the fun that it was. And essentially what he said boils down to, prior to that, the market expectation was that we would see 6 rate cuts this year and around 1.5 to 1.75% reduction this year. Monday morning, 3 rate cuts, 0.75%. It halved it. Now, is that subject to change by the minute? Sure. I'll show you the factors that could cause that to change. But that's why we saw interest rates. The very best rates had been was on Thursday, a little bit worse on Friday because some other factors. And then Monday, we kind of fell off a cliff for a minute. And then Tuesday, we recovered. And now Wednesday, we're back to even. So there's going to be a lot of volatility. And that's where I'm going to go with this at the end, is there's going to be a lot of interest rate volatility. So as real estate agents, how do you prepare your buyers for interest rate volatility? Because they go and they talk to their lender and their lender says, hey, we can get you a rate of 6%. And this is what the costs are going to be. And this is the payment. And they go, great. And they go shopping and they immediately find a house, lock it in and close, right? No, they shop for 6 months or 3 months or however long it is, or 3 weeks. And by the time they're under contract, what have rates done? Moved. And the hope is that they'll move down, but oftentimes they go up, right? And so now you've got a client who budgeted for 6% and now rates are 6.5. And what are they thinking?
Well, I got gyps.
I can't buy this house anymore.
Yeah.
I can't afford this house anymore. We budgeted for here, we can't afford there. So what I would recommend doing, best practices in a volatile market. We saw the same kind of market like 2000 and 2006 was a pretty good analogy for where the market is right now. What I would recommend doing in a volatile market is make sure that your buyers have realistic expectations. So what I like to do is I say, okay, here's the lowest rates have been in the last 90 days. Here's the highest they've been in the last 90 days. So somewhere in the middle is probably a realistic expectation. Let's budget for both ends of the market here. Because if you can't afford this rate, 0.5% higher, whatever it is, we shouldn't be shopping at this price range. Because otherwise you do all the work and you figure out where they're going to go and get them in the house and they write the offer and you get them under contract and then they can't do the financing, right? So I think it's really important right now. Make sure you have a conversation with your lender. If you need a lender, I know a guy. Have a discussion. I'll give you the card afterwards. You'll like it, I think.
Okay.
But you should have a discussion with your lender, make sure that they're giving them that information so that there's not sticker shock, especially for your first-time home buyers, because they're budgeting this tight, right? So give them an expectation, and then they're gonna appreciate you for it, right? Because now you've given them reality. And
Well, they're all trying to buy at the top of their buying power too, because
Yeah.
they can't buy as much. So they're stretching it as far as they can, so they're more likely to get bumped out.
yeah,
You may have said this already, but the volatile market going from the bottom to the top, what recently were you kind of seeing that?
in the last, well, since December 12th, so what are we going on? Not quite 2 months.
Yeah.
The swing in that has been about 0.5%. Prior to that, it was much more volatile.
Right.
The previous 90 days was more like 0.75%.
And
But
it's
last 60 days,
stable.
about 0.5, and it's getting more stable because of the market expectation of the Federal Reserve kind of being done with their rate hiking, which is what they told us on December 30th or January 30th, whenever it was, till the 60 minutes thing. Okay, so here's where we are now. So this was 2 weeks ago, this is today. So today, to get to the same odds of a rate cut that we were thinking we were going to be at in March, we're down here in the June meeting or July. So the Fed basically just pushed off their expectation of rate improvement by 2 to 3 months based on the market right now. And then to get to the same kind of 100% odds of a rate cut, we're pushing way down at the end of the year. So effectively what's happened is the market is now expecting that rates are going to stay higher for longer, which is the phrase that Jerome Powell keeps using, but now they're starting to believe him. Next meeting is going to be on March 20th. If that language is repeated, expect to see this push even further out. So that's going to be a big deal. And the data going into that, I'll tell you what data to watch for that. 12 of 19 Fed members, and this is the voting board of governors again, remember, these guys make these decisions, gals, see the unemployment rate at 4.1% or lower in 2024. So if the unemployment rate ticks above 4.1%, that's going to be a big deal because what's the Fed's job? Stable employment, stable money supply. This becomes unstable employment. So they're going to focus on that number. So if you see inflation ticking up right now, we're at 3.7 or 3.8, I can't remember from January. If we see it tick up a couple more points and we get into like the 3.9, 4, what that's going to do is bring all this back over because the Fed's going to have to take some action to maintain that. Does that make sense? So that's the sliding scale. So number one, what I just tell you want to pay attention to in news data, unemployment. Unemployment's a big driver right now. So pay attention to that number. There's your magic number, 4.1%. We got to stay below that to keep this expectation on. Yes.
So these are the Fed fund rate,
Mhm.
or Fed fund rates. Is there a lag between when that changes and you see a full impact on mortgage rates?
So this is where I get real geeky and economic-y on you. There is no correlation. There's no correlation. So they move together because they have the same drivers, but they don't move together because they're connected. Does that make sense? So when the Fed drops their rate, it's because they're responding to employment and inflation. And when mortgage bonds improve or worsen, it's because the traders are responding to those same factors. So they don't move together. In really, really general, like broad brushstroke terms, you could maybe say there's about a 3-to-1 ratio. In other words, a 1.5% change in the Fed funds rate would theoretically equate to maybe a 0.5% change in long-term mortgage rates eventually. But that doesn't always go because the Fed, if you look at the chart together, they just are all over the map. I should put that chart on here that I can show you. Okay, so you guys recognize this? Anybody take morning economics classes? I love them. So awesome. Supply and demand. We hear about this all the time. Oh, we have an undersupply of real estate. We have undersupply of housing. You've all heard this, right? Do you know what that even means? Conceptually, we do. Let me give you the graph of this. So here is supply. Here's demand. This is the quantity, how many houses there are. This is the price. So here's how this model works. If supply right here decreases, this red line moves up this way because there's less supply, and that pushes prices up to where these intersect because now you have less supply and a constant demand. If demand increases, then we have it pushed this way and we have prices go up as well. So right now we have a significant demand and a significant undersupply. So all of the things you need to really push home prices up. And this is something you need to keep in mind, not just on home prices, but on this next conversation we're going to have as well, which is quantitative tightening, which is the second reason we're going to see rates go down or up. So quantitative tightening is the reverse of quantitative easing. Quantitative easing is what the Federal Reserve started doing in 2008 to try and pull the economy out of the housing recession. And what they did is they started spending billions and then trillions of dollars buying mortgage-backed securities. Mortgage-backed securities are a bundled package of mortgage loans that are traded as a security. So you and everyone you've ever known that got a mortgage, they take that bundle of loans, they package it up, and they sell it off as a security. And it's bought as a mortgage-backed security by municipalities or governments or organizations or bond funds or 401k companies, people who want to hedge risk with a relatively safe investment, right? That's who's buying and selling these. In general terms, the more demand there is for those types of securities, the better rates go because it goes inverse to rate. The less demand there is, higher rates go because they have to raise the price and the yield goes down. So here's what this shows. This chart right here shows you the Federal Reserve's holdings of Treasury bonds and mortgage-backed securities. And here's why this is important. So from 2002 all the way up to the recession, we were sitting at about $800 billion in mortgage-backed securities held by the Fed. That number was pretty stable. Dipped down here during recession because they were selling into it because at first they thought that was the thing to do. Bad idea. And then to get us out of this, they started buying these and buying them by the gross, right? And here we are in 2014, and they went from 800 billion to 4 trillion in a 6-year window, right? And then we sat about this 4 trillion all the way up until about 2019, and the Fed said, hey, I think we're out of the woods. We're thinking maybe we're going to think about someday dialing this back, maybe. The next day, interest rates went up by 0.75%. And then they actually did it, and rates jumped another 0.5%, right? That's where we were right here. And then 2020, and then boom, buy. And what the Fed was doing right here is they had committed to buy all bonds and mortgage-backed securities at face value. So to put this in perspective of housing, imagine that you had a buyer who would buy any house at what you said the market value was. How much incentive is there for the seller to do anything? Are they going to clean that house? No, none. This is what we created. We had an infinite buyer, regardless of the quality of that security. So of course, well, we could drop rates down as low as we want because the Fed's going to buy it all. So they did, because they could, because there was a buyer for it at any level. And that continued right up until, remember these dark days of January 2022, when all of your clients that were under contract to build that thought they were going to get a rate of 2.5, found out they're going to get a rate of 9, or whatever it was. And rates literally in that 8-month window went from 2.5 to like 7.8. It's awful. That's what this is right here. The Fed started selling off these mortgage-backed securities to the tune of $1.1 trillion a year. Okay. So do the math here. We were at 4.1. We went up to about 8.7. They got to get rid of $3.6 trillion to get back to that same level they were. And this was an inflated level. This was to get ourselves out. And we can see they didn't want to have all these then because they were trying to sell out of that position before COVID. So really, they'd like to be back down around here. So there's a long ways to go. And they're unwinding this position. That is quantitative tightening. And it's tightening because they're tightening the market by adding more supply in. And like our supply demand model, you have more supply. That means that the price is going to have to change to accommodate, which is going to drive rates up. That's it. That's why rates are moving. That chart right there. This little chart right here is a funny thing. This is just to illustrate banks can move in tandem with the Fed. When the Fed opened up their buying window, this goes 2021 to 2024. So it tracks kind of like this right here. So when the Fed changed some of their standards, it allows banks to hold less of these bonds as securities. They could basically divest themselves of these into the Fed holding and offload some risk, which was really good. And I'll show you why that matters in just a second. Okay, so here's this. That was a graph. Now here's the numbers. Average range from 2014 to 2018, elevated rate of $4.25 trillion. Just the 4.2 trillion, right? It's not even a 5, right? We were good. But here's what's important. There's about 22% of our GDP. You guys know what GDP is? So GDP is our gross domestic product. It's all the stuff we produce as a country stuck in a basket, okay? So as a percentage, it's kind of like the debt to income ratio for countries. How much debt do we have? What do we produce on an annual basis? So the GDP was 22%. And then we went to 33%. That'd be like your borrower going from like a 42% debt to income ratio to an 80% debt to income ratio, right? We just blew money like crazy in producing these bonds. And so here we are. And then the Fed says, let's start getting rid of these. So they sell off January of 24, we're down to 7.1. So that's where we were last month. And you can see we're still at 25.6% of our GDP. So projecting growth in the GDP based on what we're seeing in some economic models and projecting out what the Fed's doing right now with their balance sheet, we should somewhere around June get to this. And July, right there. Is that going to be good news? Because what can the Fed afford to do now? They can dial back because GDP continues to grow because as consumers we're spending like crazy, right? It has all the stuff the Fed has done has not slowed down consumer spending at all. And that's feeding our GDP. So GDP continues to grow. So when we get to this level, well, the Fed can say, hey, I think maybe it's time to dial back on this quantitative tightening thing and sell less. They're not going to stop, but they might chop that number in half. Does that make sense? So do you remember when we were thinking we might see some rate cuts? Probably June-ish. Starting to look stuff's coalescing here. So this is where we could potentially start seeing the Fed talking about that. So here's the next thing you want to look for. I told you unemployment. The next thing is quantitative tightening or Fed balance sheet or anything that talks about the Federal Reserve and bonds, because them changing that position is what's going to change interest rates. Just plain and simple. And probably somewhere in the middle end of summer is I think where we're going to start seeing that happen. So right now, what 60 Minutes, what Powell said is that they're, if I can remember it exactly, it was basically they're starting to think about talking about it. Like a second derivative of talking about it, right? At some point, maybe they're going to start talking about it, but now they're thinking about starting to think about talking about it. As far away from actually doing anything as you could possibly be, but still make news with it. And Powell has the habit of doing this. The Fed really has done this since Bernanke, and that is they kind of say, maybe we're kind of thinking about someday we're going to do this. The markets realize they're just saying this is what we're going to start doing, and we're going to slowly walk. It's like when you get into a cold pool, you like kind of dip your toes. Maybe this is just me. As a visual, you like that. You kind of, ease in. I don't jump in. I hate that. That's what the Fed's trying to do with us on this. They're easing us into the cold plunge is what they're doing here, trying to get the market prepared for that eventuality. Here's what this could do for us. So 2024 deficit, this is the money that we're going to be in the hole as a country this year, just the $2 trillion. New agency mortgage-backed securities. So this is new mortgage bonds. This is new purchase loans. They're going to be completed this year, 1.1 trillion. That doesn't mean there's going to be $1.1 trillion of new real estate built, but that means that is going to change hands and new buyers are going to purchase it, new loans produced. A lot of that, by the way, I think is going to come from homes that right now are free and clear. And I'll talk about that in a minute too. Then we're going to see the Fed selling off 1.1 trillion. That means that the market's got to absorb $4.2 trillion worth of this type of bond and security. So when you hear about the debt ceiling being changed, this is what they're talking about. How much more are we going to add in? Because every time the federal government spends a dollar that they haven't collected in taxes, what happens? More treasury bonds, more debt, more debt. We're offloading our spending into debt, and it's going right here. So now the market's got to absorb $4.2 trillion, which is a massive amount of money. And it's going to cause rates to be really resistant. If, however, the Fed says, we're going to dial this back somewhere where we're thinking they might, and they chop that back from 1.1 to maybe they drop it down to like $0.7 trillion. That's going to be because that other chart I showed you, give banks the ability to dial back their sales. And now banks can basically hold and retain these, which means they're not putting them in the market. And we could potentially see a 25% decrease in the supply. So imagine what would happen if you had a 25% decrease in housing supply. What are prices going to do? They're going to go up. Same thing here. And when prices go up, rates come down with this particular model, with these securities, right? So if this happens, that could be really significant for interest rates. So that's why you want to kind of keep an eye on that, be aware. This is the thing that's driving behind the scenes. Now, one note on this. The only time that interest rates ever went below about 5.5% was a combination of COVID and $8 trillion of Federal Reserve mortgage bonds buying. Are we going to see those two things happen again?
Hopefully not.
Hopefully not.
Right.
Very unlikely. And the Fed is probably not going to buy $9 trillion of mortgage backed securities. They can't.
We'll call it something.
They'll call it something else. Monkey flu. We already did that. I'm trying to think of one we haven't done yet. It's escaping me. So the likelihood of the Fed engaging that quantitative easing again, remember, this happened because of a 100-year financial storm of the housing recession. That's the only thing that brought that on. So I know you got to be prepared for the 100-year flood. That's basically what we're saying. If you're thinking rates are going to go back below 5.5, you're thinking there's going to be 200-year floods within a 10-year period of time. Not highly likely. So if you have clients who are sitting there saying, well, we're going to wait for rates to get back down. You know, I mean, I've got friends who have rates at 2 and 3 and 4%. We're going to wait for rates to get back down there. What do you now know? How low are rates likely to get? About 5.5. Taking the Fed out of it, and there's a model for that. We could look back again, that 2000, 2006, you can see that happen. That's kind of where rates bounce back up. Interest rates should be around 6.5% for the relative risk of mortgage-backed securities, which is right about where we're at right now. So we're actually kind of in a stable market right now, crazy enough, for rates. So people who are waiting for rates to go back down into the 4s to buy, are they ever going to buy? So what do you do? What do you do with that information? Educate. Bingo, that's what I would do. You got to really help them understand, hey, the reason why rates were there is because of these two very unique events that happened that pushed rates down that have never happened before and are very unlikely to happen again. And if you're hoping for rates in a 3, you're also hoping for deep recession, 11% job, unemployment, and like mass layoffs, because that's what it would take. Probably not likely. Possible, but I wouldn't wait to buy a house because of that. So educate your clients. If that's what they're waiting for, what I'd like to do is say, hey, if you're waiting for rates, what is it that you're waiting for? Like, what to you would be your rate that would make sense to buy at? And if they go, oh, like 4, okay, well, you're going to have to help that person understand that's very unlikely to occur. And by the way, if it does, what's going to happen to home prices? It's crazy, right? So it's going to go up the other way, but it's a very unlikely event to occur. And so we've got to just help recalibrate that expectation of, well, I know they were there once, but this is kind of where we should expect them to be, is in this range right here. So if they get into the middle, lower end of that range, that's a pretty good idea. That's a pretty good deal, and which is where we're at right now, which is why we're seeing multiple offers on homes, because people are coming back in the market. Okay, let's talk about point number 3, which is recession. This chart right here, the blue is the 30-year fixed mortgage rate. The red is the treasury bonds. And the reason why this is important is you can see how they kind of track each other over time. This goes back to like 1973. So you can see how they kind of move in tandem. Mortgages move with treasury bonds. But what's interesting is if you look at these gray areas, these are where we had recessions. What happens to interest rates during recessions typically? They go down. So if we have recession, thank you, there's a good probability that we're going to see interest rates improve to some degree. There's a lot, and there's another thing, here's the next thing to look for, is talks of recession. And they're now talking about a soft landing, a hard landing, and a no landing recession. So in normal person words, what that means is a hard landing is recession, unemployment, bad stuff. That's where people were thinking maybe we'll be there, maybe we won't. The general consensus in the financial markets is that's an unlikely event. The likely event is soft landing, which is we kind of ease into a recession, but you kind of don't really notice it unless you're reading the news. And the no landing is now where more people are going, which is we're just going to continue. We're not in recession. We're just kind of in a new version of the economy, and this is where we're at. And prices are going to do what they're going to do. And that's becoming more and more likely if the Fed can kind of dial in what they're doing. So that's a fairly likely outcome. So recession is probably not as likely as I think people thought it was in the past, at least when you look at the futures market. The other thing I want you to notice, though, is the spread between these two. And you can see that in recession, the spread widens. So in times of financial distress, the spread between these two widens. And right now, we're pretty wide. Here's why this matters. The average spread is 1.7%. The spread today is 3.1. So if that spread returns to average, which it will, what does that mean interest rates can do? You can go 1.5% better than we are right now. Like 1.4%. Just if we see a return to average. And what's going to return that to average? There's a phrase in the mortgage world that the cure for higher rates is higher rates. So as rates go up, all these other things happen between what's buying and selling in the back end of the market, the treasuries and all that bond stuff. And it kind of levels things out, kind of brings it back into a little bit of a cohesive place. So as rates have gone up, it's eliminating the risk that was associated with 3% loans. Do banks want to have loans at 3% outstanding right now? They do not. In fact, let me just divert from this conversation real quickly and talk about something else that I think would be useful for you. I get calls at least weekly about fake seller financing. You know what I'm talking about? Not assumptions, not assuming a VA loan or an FHA loan, but seller financing where the seller has a mortgage and the buyer is going to come in and just start making payments on the seller's mortgage and then pay some cash for the difference. Here's the problem with that. If they have an underlying mortgage that was through FHFA, which is basically any mortgage, part of that mortgage deed of trust that was recorded was a due on sale clause. And that due on sale clause says that when you transfer title outside of a trust, you have to pay them off. In the past, and people will tell you this, and I would tell you the same, banks have not enforced that due on sale clause because they didn't care. Well, it's two things. They didn't care and they had no way of enforcing it. Because rates are at 5.5, they're at 6.5, they're at 6, they're at 7. It was within a relatively decent range. So you're making the payment. It's not worth the brain damage for them to go and track you down and say you transfer title unless you stop making your payment, you don't pay your insurance, right? They didn't care. And they had no modality of enforcing it because they would have had to go in and do a title search in every county in the entire country every month and see what had changed on title and then match that up with their database. Not anywhere near worth it, right? But what's changed in the last 6 months? AI and online county records. Who's pushing for online county records? Anybody know? The banks. Why would they want those online county records? Well, now they have access to that data Everybody does. And it's great. I love it. It's super easy. There's a great website Utah has. You can find everything on one website. I love, like transparencyutah.gov. It's awesome. So the banks can go in and they can couple that with AI, and they can now go in and see, here's all of our holdings. Where do you need these transferred in title? Click, click, click. Now they know. And they don't want those loans to be transferred. They want them paid off. The average time that somebody lives in their first home in Utah is just under 4 years. A move-up buyer lives in their home for 7. These loans are going to be on these books for a lot longer. And if they allow people to get away with the seller financing thing, it could be a 30-year loan that they plan on having for 5 to 7. They want those loans paid off. So if you're engaging in seller financing right now, I would be very, very cautious that you have a very strong exit strategy that could be, yeah, you need a plan B that you could implement in 30 days, no questions asked, because you might get that opportunity. Whole bunch of other reasons why it's a problem, but there's just one. So bottom line being, as that risk abates, these spreads will return, because they always have, and they will again. And as we come out of this financial crisis, recession, soft recession, whatever it is, we come out on the other side, those are going to come together again. And so we're going to see interest rates drop down because of that. Does that make sense? So as we find stability in the economy, there's about a 1.4% rate improvement. The other reason why there's an unusually large spread right now, and this is what gets us into point number 4, which is government intervention, is government intervention. Are you guys familiar with the Fair and Equitable Housing Program? You heard this? Are you aware that, you're probably aware of this, effective May of this last year, that it became much less expensive for a first-time home buyer with income under a certain level to buy a home, and much more expensive for everyone else? You guys seen that? Yeah. That's Fair and Equitable Housing Program. So the FHFA said, hey, we got a great idea. We need to incentivize first-time home buyers, make it easier for them to get into homes. By the way, is that good or bad? First-time home buyers, good?
Good for the individual.
Vital. First-time home buyers are vital. They're vital for our economy. If you don't think first-time home buyers matter, look at 28 when first-time home buyers went away and it crumbled the housing market. First-time home buyers are vital. We need people buying homes. It's a major pillar of the U.S. economy. Like, it cycles through. So yeah, first-time home buyers are great. It's good for people. We all know the value of wealth building through real estate, or you wouldn't be sitting here, right? We believe in home ownership, or you're in the wrong place. You're in the wrong industry. So you inherently think first-time home buyers are good. So do I. It's good for my business. It's good for the economy. First-time home buyers, great. So the idea of providing more opportunity for first-time home buyers, awesome. Doing that in the way they did it, debatable. Personally, not so awesome. There's people who love it. But the bottom line being, that program is a Biden administration program. If we have Biden administration part 2, that program will expand. And we'll see the spread hold or maybe even widen. We don't have a Biden administration part 2, that program will probably expire. There's a lawsuit right now working its way through the courts, a constitutional matter saying that program violates constitutional rights, which, probably does. Equal protection law. That document you always have to sign. Yeah, well, details like that. But the bottom line being, depending on where the political winds go in the fall, could have a big impact on this. So now let's talk about how this could be impacted elsewhere. Anybody know who Janet Yellen is? Janet Yellen is the Secretary of the Treasury. You know what Janet Yellen's job was before? Before she was a Secretary of the Treasury, she was the chairwoman of the Federal Reserve. She handpicked her successor, Jerome Powell. So she went from the Federal Reserve to the Department of Treasury. Does she want job security? Does she want to be the person who presides over the crumbling economy? She came out of the Federal Reserve pretty rosy. She did a pretty good job. People liked her. They thought she was great. She was ready for her book tour. And then she got tagged for the White House. And wow, even better, right? Well, I don't know if she wants to preside over the failing economy. But who's on her cell phone? Who's on her speed dial? The chairman of the Federal Reserve, right? She picked the guy. Clearly they have communication. They're talking about different things. I think it would be silly to assume they're not talking about this. And if you wanted to make sure that people were favorable to an incumbent, wouldn't it be a good idea if interest rates could improve maybe in the fall? Wouldn't that make people feel better? Maybe that would bring gas prices, inflation down too. Would that be good? So there's ways to do that. You can just stop Fed quantitative tightening, and there's already good justification for that. So I would imagine that there's probably some political pressure related to that quantitative tightening piece, right? It would make sense to me. And that could cause a significant change in interest rates up or down. So when people say, oh, political rates improve in an election year, kind of, but not directly related. It's more to do with expectations and risk. It might be directly related to this year. Okay, I think I beat that dead horse. So what are rates going to do? Here's what I would help people understand. This is where I think rates are going to be for the next couple of years. 5.5 to, and I actually, after January, I updated this, bumped both those rates up by a quarter. I think we're really 5.75 to 7 1/8 based on where we're at right now. Rates under 6% are going to absolutely unlock move up buyers. You see a 5.99999999 rate on the billboard. All the people who are like, I cannot stomach moving to a 7% rate. Oh, but it's the 5s now. Maybe we can finally sell this house we've hated for the last 5 years. Because how long, I told you, how long does the average first-time home buyer live in their home in Utah? Typically 4 years. Move up buyer, 7. 7 years ago, we're 2024. 7 years ago, 2017. People were buying houses before we ran out of inventory at reasonable prices. And now, how much equity do those people have?
Wow.
Even if they refinance, they've got a ton of equity. But they also refinanced in 2020 to 2.5%. And so they're looking at going, I got all this equity. I hate everything about this house. I am so itchy to move. Do you have conversations with people like this? But I cannot afford to move. That's going to change when we see a rate with a 5 in front of it for any appreciable amount of time. So what can you do knowing that? What do you want to do? Who do you want to be talking to every single day or week or month? How about all the people you know who bought houses 4, 5, and 7 years ago? Because when this hits, they're going to be ready to go. And when they're ready to go and move, what's going to be the natural inclination of the person who hasn't heard from you in 3 years? Where are they going to go? Somewhere else. They're going to go online. Let's be honest. They're going to go to Zillow and Realtor.com, and they're going to call the person who paid $10,000 a month to be on that website. And that's fine if you're paying $10,000 a month to be on that website. But if you're not, and you want to retain your client, right now, I think it's crucial to be top of mind in front of those clients that bought 3, 5, 7, 8 years ago that have been sitting in a house. And the way that I would maybe do it is you reach out to them with some value-added offer. Maybe it's a CMA. Maybe it's just a conversation. Hey, how are you doing? How's your house? Things still working out for you? Oh, you hate the kitchen, really? Yeah, interesting. And what would be a good fit for you? What would that look like if you, how would that feel if you could get out of that kitchen? Wouldn't that feel great? Oh, you got 3 kids since you bought that house? The 1 bedroom? Yeah, I bet that's tight. How's that feel to be in that house? What's the word I'm telling you to use? Feel. Because the logic isn't going to do it. Because the logic is keeping them there. How does that feel? What would it feel like? Maybe there's an opportunity here. I mean, I've heard that rates might be improving a little bit, but when they do, prices are probably going to go up. So maybe there's a way that we can help you get into a house that's a better fit for you right now. If I could help you find something that would be a better fit and be affordable, would you want me to let you know? Okay, right? And so now you've gotten in front of those people again with a nice, easy script. And the other piece on this that I'm going to mention, well, we'll get into just a second, housing inventory. Here's what's going to change this. If unemployment goes up, or if this interest rate thing drops down significantly lower again, which you can never expect, or this government intervention, that's going to change this whole model. But absent those 3 things, we're probably seeing rates volatile, but dipping down in the fall. Okay. Where are home prices headed? Let's talk about this. That's our second question. This is all transactions from 2018 through current. By the way, most of my data I pulled from the Federal Reserve. If you like data and charts and graphs, you can get all this stuff for free at the St. Louis Federal Reserve. It's the data repository for the Fed, and there's a lot of graphing tools they have. It's pretty cool. So this is all transactions from that period of time. So look at this. This is 2022. So about January 2022. This is November of 2023. Okay. So from January 2022 to November 2023, that group of people. So we've got about 20 months worth of buyers that balanced out. Now we're here, 2023, and look at this line right here. Who's underwater? Basically, it's people who bought from about May of 22, or yeah, so the middle of the second, yeah, about May of 22 to August of 22. So we're talking about 4 or 5 months worth of people that are underwater on their home. Does that make sense? That's it. That's it. Let's talk about this. This is the recession. This is housing recession. So this is 2005. So here we are 2006. Here we are 2012. How many years of people were underwater? Right? You took 6 years to get to even. How many of you know someone personally or related to someone who lost a house or a company during the housing recession? How many of your clients know somebody? All of them. How psychologically imprinting was that event? Deeply, deeply. And so people think this 5 months is the same as this 6 years, and it's not, right? When was the very best time ever to buy a house? I'm going to tell you, it was right here. Housing inventory in Utah was 11.2 months inventory to supply ratio. It took 11 months to sell a house at market price, and prices were just the bottom right there. But how many people were buying right here? Nobody. Everybody was terrified. So if you bought right there in 2011, how happy are you in 2018, 2019?
Yeah, but I sold it last.
I know. I talked to somebody yesterday and they're like, I bought a house for $92,000 right then. I'm like, how much is it worth now? It doesn't matter because I can't sell it because my rate's too high or too low. Okay. So you can't equate this with that, right? But that's what our clients are doing, and they feel like it's the same. Is logic going to help them overcome that? No way. You got to talk. Okay, let's talk about how is this feeling like? What's causing this? You know, what does this feel like to be worried about? What are your worries? What are your concerns? Like what's driving this decision for you? And it's not the numbers, because I can tell you, if you have a mortgage that's on a home with a lot of equity, and you got a rate of 3% or 3.5% or 4%, and you're faced with a choice of sell that home, take the money, buy a new home, or keep that home, rent it, buy a new home, and you have the ability to put 5% down on the new house, your payment difference is going to be about $100, keeping it versus selling it. That's it. So when people understand that math, are they going to feel different? I do that math with people all the time. Here's option A, sell, buy. Here's option B, keep, rent, buy. And if it's $100, $150, $200 a month to keep a rental property, right? Because you're paying the principal down by more than that on a monthly basis. Yep. And so if you can help appeal to that logic of it, well, let's look at some options and alternatives. Let's do some math. And if you need some help with the math, I know a guy who does math pretty good. I'll do the math for you. I'll send it to you. You can present. But there's an opportunity there to help people kind of move past that by giving them some really good information and then helping them understand why it is they feel that this 6-year period is the same as that 5-month period. And maybe explaining that to them, be like, well, here's the reason why I think a lot of people are really nervous about it is because they know somebody who lived through this and it was pretty emotionally scarring, right? You know somebody. We're going to bond over that because we all know somebody. Well, right now, it's a really different story. This was 5 months from the top to the bottom. In fact, if they're waiting for the bottom to buy, they missed it. It was November, right? So they missed it. But does that mean it's a bad time to buy now? So we're 7 months out of the bottom. Would you have loved to buy 7 months out of the bottom of this? Yeah. Right?
Actually, wouldn't you have loved to have bought at the height of that?
Yeah. So now here's the interesting thing about that. If you bought right here, you kept it for 12 years, you saw a 3.15% gain on the asset. So you bought a house with 5% down, you bought it for $100,000, you sold it, that home went up annualized 3.15% for 12 years. So it wasn't 3.15% on your 5% down, it's 3.15% on a $100,000 home. And that's if you bought at the absolute worst time to buy. Does that make sense? So you buy and you hold for 10, 12 years, you will make money. If you bought at the bottom and you held for 5 years, you got a 4.5% return on that, but only for 5 years, right? So where are we in the cycle right now? We are coming out. We're on our way out. We're not here. That was this. We're on our way out. Okay, so this is another interesting little chart right there. This is the change in median home price for the last 2 years. And you can see that we've had year-over-year change, even using the most unpleasant of math. From July to July, it was 2% decrease, and that data is now outdated. I couldn't find more recent data. If you did it now, most things I'm finding, but I couldn't verify it, or saying it's anywhere from 4 to 5% increase from 1 year ago. Where are home prices headed? This is another chart that gets the news every now and then. You guys have access to this, right? So let's just look. Well, great news. Daggett County went up by 9% year over year. So they had 18 sales. So like one person sold their house for an extra 10 grand. Prices went through the roof. You know, Salt Lake County here went down 3%, and people see that home prices are going down. Are you guys experiencing a decrease of 3% in Salt Lake County from last year? We're talking about median home prices. What's happening with new construction? So the state government decided it would be a great idea to help builders out by creating a program that's really not usable for anybody, but it really benefits builders if they build townhomes for less than $450,000. What are builders now incentivized to do?
For less than four.
Get townhomes to the ground so they can convince people that it's a good idea to use this down payment assistance program, which, by the way, I can give you lots of math on, it's garbage, but doesn't change the fact that that's created this incentive for that price point. So what should you expect median home prices to do? Were they building $450,000 townhomes 2 years ago? No, they weren't. So median home prices will go down. That doesn't mean home prices are going down, right? So you got to be a little careful when clients. So again, educating clients. Yeah, I know you're seeing that, but let's look at this specific home you're interested in. You're looking for a 2,200 square foot Rambler up down brick in Murray, Midvale, Sandy. Let's look at that price a year ago and that price today. That's the price you care about, not this data. But this is the data that hits the news. So make sure that you're giving your client the right information so they can then feel better about it. Anytime you've got a financial decision, I found there's really two components. There's like this financial decision where you do the math, and there's the emotional decision where you decide how you feel about it. The problem is most people flip it and they decide how they feel about it before they do the math, right? They make these preconceived notions of decisions based on what they think and how they feel without actually having data. Well, you guys have data, and now you got more data. So what you can do is get the cart back in the right order of the horse and say, hey, here's some real data. Before we really get into this, this is what you're looking for. This is what it was a year ago, 6 months ago. This is kind of where the market's going. How do you feel about that price point? Well, they're going to feel real different knowing that this is the real numbers. Does that make sense, you guys? Mm-hmm. So that's what I like to, okay, so where are home prices heading? These are the three drivers for home prices: population and household growth, jobs, and the overall supply. So let me break those down. This is our population, the red line in Utah. Blue line is unemployment. And here's what's interesting about this chart. You see these spikes in unemployment? There's a big one. This is housing recession. This is COVID. See these spikes in unemployment? Do you see those spikes or changes in population? Our population is growing regardless of employment. So we see a little bit of a change in employment. Is that slowing down the number of people being born in and moving to the state of Utah? Absolutely not. So is this going to change the demand for housing? Absent something like this major event, we're going to have population increase. And during this housing recession, it's not going to change the demand for housing. It just caused a lot of consolidation of households, right? Everybody moved in with their family and friends and double bunked, and it's taken 15 years to unwind that. And now we're unwinding it, and people are buying homes at 35 instead of 26, which they normally would do. And it's created this massive over demand and undersupply. Okay, let's talk about unemployment in Utah. We're at 2.8%. What did I tell you the numbers you want to watch for? What's our red zone in unemployment? You remember? 4.1, 3.7% right now. Utah, looking pretty good. We're 2.6329, up here, Box Elder. There's like 12 people in Vernal, they're all employed. That's not fair, Vernal's so we're a far cry from 4%, and we're a big far cry from 10%. If we get into a housing recession, these numbers need to go to about 9.5%. So to go from 2.8 to 9.5%, we're talking about an immediate evaporation of hundreds of thousands of jobs. Think that's coming? I mean, I can't even get a drive-through sandwich because they don't have enough people there after 11 o'clock at night. I've got a client who's a hiring manager at Hill, and she was telling me that they're hoping they can get almost all their jobs filled this year, that they're only going to have like 12 to 18,000 surplus jobs by the end of the year, unfilled jobs. So if you're a government contractor and you've got a contract to hire engineers and you can't hire enough engineers to meet your contract, what do you have to do? What are you going to raise? You're going to pay more money, which is what we're seeing. So I'm seeing clients moving here from California because they can get paid better to live in Utah. That has not happened in 27 years because there is a jobs vacuum. We need people working these jobs and we cannot fill them. So we're not heading towards, at least right now, a 9% unemployment rate. So when you're talking to clients, they're saying, well, I'm waiting for home prices to go down. Are home prices going to go down? No, because unemployment's not going to change it unless it gets really bad. Our population is going to continue to grow. We're nowhere near that number right now. And to get to a housing recession, there's only been 3 times in Utah's history when that happened. All of them coincided with significant unemployment. Does that make sense? So unless we're getting to that, we're not seeing housing prices go down. Okay, let's talk about the housing shortage. This is the supply piece. Governor Cox, you guys might have seen this a couple weeks ago. He said he's going to put $150 million in the budget to build 35,000 new starter homes by 2028, which is great news. But here's where we're at right now. This is from the Gardner Institute. There's 37,000 more households in the state of Utah than there are total legal housing units, apartments, complexes, duplexes, everything. So there's 37 more households than there are housing units. Are home prices going down? No, because if there's a tiny budge, one of these 37,000 households is waiting to buy it. What if 25% of our workforce can't afford a home? Okay, there's 37,000 unhoused people. How much inventory is on there on the market today in all the state of Utah? Do you have any idea? Anybody look at that?
An actual number?
Yeah, like 8,000 homes listed in the state of Utah, something like that.
Yeah.
So 37 unhoused households, 7,000 total homes, including mobile homes and raw land, something like that. You've got housing. So by the way, if you follow these numbers out, if we continue on current projections for construction and our household population continues to grow, when Governor Cox's program of 35,000 new homes kicks into place in 2028, yay, we'll be all the way down to 49,000 deficit. We'll have capped it just under 50. Nice. So, we're stepping back in time there. So it's very unlikely that that demand is going to change. And the other piece that's not on this chart is the change in our demographics. So historically, Utah has grown majority-wise by babies and then move-ins. So 60%, 62% of our population growth has been newborns, and 38 to 40% has been adults moving in. That flipped in 2022. Almost exactly 60-40 the other way. So 60% are now adults moving in and 40% are babies. So how does that change the housing demand? Because if you've got 10 people and 6 of them are babies, you might need 3 to 5, maybe, depending on household size, 3 to 5 households. If you have 10 people and 6 of them are full-grown adults, maybe you need 4 to 7, right? So not only is our population continuing to grow, but it's growing in a different way than it has before, which is increasing this supply issue. And then on top of that, how many of you know somebody who has bought a home and kept their existing homes in rental? I love that strategy. It's genius. You got to rate it 3%. Never sell that house. Oh my heavens. If there's one thing I could tell every first-time home buyer is buy a house and then never sell it.
Yeah.
Did you sell your first home? Did you guys sell your first home?
We still have it.
We sold ours because we were dumb. And it's like gone like 4 times in value in 20 years. Don't sell your first home. So, but if you can keep it, rent it, and cash flow it, good, right? That's awesome. But the problem with that is that's happening more and more because you do the math, as I said, there's not a big difference. So you have somebody buy a new house, but now they turn their existing home into rental. So you've increased the inventory of rental units, but you have not increased the inventory of available housing units for purchase, right? You've actually decreased it because you took another one off the table. So as people are doing this move up, keep and rent, which is becoming much more popular for justifiable reasons, it's also impacting that available shortage of housing units for purchase. All this stuff. And it's not changing. By the way, in Utah, we typically have 6% more home ownership than the national average. This is United States, this is Utah. That changed only in COVID because everybody decided to buy a house. And then we went back down to normal. And now here we are in Utah, kind of climbing back up out of that even. Another reason that I bring this up, another question I have people ask a lot is affordability. Oh, but home prices are no longer affordable. So I went and did the math because I was curious. And I thought I was going to get a different answer than I did. So what I did is I took the median home price, I pulled this data from the Federal Reserve. So it might not be right, but it's consistent internally, if that makes sense. In other words, this is the Fed's version of these numbers. So the median home price 24, 21, 28 to 2000. So go back to 2000, buy a house for 164,000. You make $3,900 a month. So you're about $48,000 a year in income. You got an 8% rate. So 6.5 too high. 2000, we were doing 8%. People like, yes, I got 8. All right. It's got a 7 on it. I'm buying. And then you go in and you look and you see what their expenses were for that year for average debt carrying and things like that for an average household in Utah, which we can find online. After tax dollars, they had 1,076 left over in residual income in 2020. Put that into 2024 dollars, that's just under $1,900. Okay. 2018, same math. 2024 dollars, they have $2,400 because rates were really cool. 2021, same math. Now they have $2,400. 2024, same math. Now they have $2,300. Are homes more affordable now than they were in 2000? Mathematically? Yes, that's the answer, right? This is the math. That's the answer. How many people know that? No one, because they're looking at this, right? They're looking at this as a percentage of income. They're saying, oh, 25% of my income is residual income. Yeah, but what could you buy with it? And your income went from $4,000 to $8,500. Now, is there an affordability index or affordability crisis for people with lower incomes?
Yes.
Absolutely. Because in 2000, if you made $2,500 a month, that could probably help you get into a home. And we did. It's not going to happen right now, right? So under that median income level, it becomes much more difficult to buy. Is that going to change? Doesn't matter how many government programs we throw at it. Ask anybody in California. Is that going to change? The more government money we throw to try and fix this problem, all it's going to do is what it's already done, which is raise prices. There's all these secondary impacts. So that's just not going to change, you guys. So what do you do with this? So let's look at our crystal ball. Here's what I think. Home prices 1 to 4.8%, just depending on these factors. If interest rates go down, we're going to push up to the top of that, in my opinion. If they stay steady, will probably be a little bit of an improvement. And the only reason they're not going to go significantly better is if rates don't come down, there's a lot of people just sitting in their house not moving, and we don't have the inventory to be able to get homes moving. I'm seeing rates here. I told you I bumped it up by a quarter from my previous projection. I think our average is going to be around 6.5. So if you can get a rate of 6.5, is that good? That's pretty good, right? And it's funny, there's a weird psychology here. So I'm working with a client right now. When we started their loan, they were going to get a rate of 6.5% with a credit. So we were paying their closing costs. And then rates got worse, and then better, and we're right back down to where we started yesterday. And I call them up and like, hey, good news. We're right where you started. Good news. Did they lock? No, they didn't. There's a reason why Vegas casinos have big, huge, fancy buildings, because people don't take their money off the table, right? You can win all you want. You're going to give it right back plus some, because, oh, I'm on a winning streak. It's going to come around. So now, oh, it's improving. So what if it improves some more? Let's wait until it improves better. I'm like, oh, we already played this game and we stayed up hours worrying about it at night, just lock the loan. But that's okay. People make their decisions. Let's educate them. That's what I think is realistic expectation on interest rates. Here's the thing. If rates are stable, we're going to see these move up buyers coming back in, but a bigger percentage of them are going to keep their houses rental. So if we can keep rates in that 6 to 6.5 range, instead of selling, people can do the math and go, oh, I can keep it, I can buy, and this is all going to work out. And isn't that neat? Because rents are good. First-time home buyers, in my opinion, are going to be a smaller percentage than they were last year. Last year, first-time home buyers kind of run the market a little bit. And most of those we're going to see coming from out of state, because that's where they have the income to qualify, right? The first-time home buyers in in-state are probably living with family. And they probably make income that's at least 50% of the area median income. In Salt Lake County, that's $110,000 is the median income, so $55,000. If you make less than $55,000, it is going to be really, really hard to buy a house. So with all that, and then lastly, here's my other prediction. I think the inventory of existing homes is going to come largely from seniors who are moving out of their home to get more accommodative housing. That's where we get new inventory. Because if you're in retirement or going towards retirement and you've got a house and it's free and clear, and you can go get a reverse mortgage on your new patio home, do you want to become a landlord? Probably not. You're going to sell that thing. So this creates new inventory, right? This is the place where you're going to get new inventory. So what do you do with this? How do you market this?
Talk to old people.
I would get to know some great people in nice neighborhoods. Yeah, yes, right. You get that accessory dwelling in the backyard, that little pop house, right?
Yeah.
You rent that sucker. First-time home buyers. What if you're spending a lot of time, money, and efforts marketing to? That was fantastic. A lot of time, money, and efforts marketing to people that are living in mom and dad's basement that make less than this. How productive is your time going to be? None. It will not be productive. So do you write those people off and say, sorry, you can't buy?
No, you just educate.
What's that?
You educate them.
Educate,
Say-
drip campaign,
Contact.
make sure that you're putting your time investment. James and I were talking this beforehand. Make sure you put some barriers up around your time so it doesn't get just sucked out by people you can't help, and help them set a plan, right? I'm all for making a plan. Let's get you into a plan. With these people right here, the education I think you need to do is you cannot buy your parents' house. The reason we have an affordability crisis that people think we have is because people want to buy mom and dad's house as their first home. So 20 years ago or 24 years ago, when we bought our first house, we did not buy the house that matched our parents' houses. We bought the house that we could afford. And then we lived there for a while. And then we moved and we bought a different house. And it used to be that's the way that people thought, right? You buy the house you can afford, and then you fix it up, do some equity, and that's cool. And then you sell it, you make some money. And maybe you do that a couple of times. You don't just move right into the neighborhood you always want to be in your whole life, and the house you really want to live in for the rest of your life, right? But that's this weird perception. So we've got to educate those people of, hey, your goal, what's more important for you? To live in this particular home or to be a homeowner? Because this won't happen right now, but this I can help make happen. So with my help, we can get you to this home you want to be in, but we got to have a plan. And it's not from A to Z, it's from A to B, then to C. Does that make sense? So that education piece of here's our plan. Let's do some math. Let's see if you buy this house you can afford today and you live there for 4.5 to 5 years. Here's what likely appreciation is going to be. Then I'm going to help you sell that home. This house over here is going to have gone up in value too, but we got you in the market. So at least you got some gain here. And now you've got a better job because we're going to figure out how much money you're going to make. Cool. You're not going to spend money. You're not going to buy 2 new trucks. Don't buy new trucks. No new trucks. Reinforce that one. No new trucks. And then you're going to buy house number 2. And we're going to look for a home you can go in and do some sweat equity, fix up, remodel, do whatever you're going to do. And that's going to be great. And that's going to be about the right time. We're going to see a lot of seniors selling their homes in 5 to 7 years. So there's going to be some opportunity to buy a house. And you live in that house for 3 or 4 more years. And then your job is going to continue to go up. And now look at you. You're in your dream house. And it took you 10 years, but you're there. And along the way, you made a lot of money and you owned a home and you had all the pride of ownership. And people buy houses, there's a psychological impact on their income, and that's statistically true, and it's going to do nothing but help you. So let's get you going on this path. Does that make sense? We've got to help people understand they cannot just go from here to there unless it's within their needs. That if we can help them find the path, well, what did I just tell you to do? How you can do? Instead of getting 1 transaction for something they can't afford that they're not going to close on anyway, how many transactions did you do in the next 10 years? 3. You did 3 transactions for a client who will love you because you helped them get there. And then they're going to refer all their friends and family because look what you did for them and how smart they were by choosing you. What a great decision they made by choosing you because you're such a great agent. You're their agent. Does that make sense? Okay, so I'm going to wrap this up. Who's your market right now? First-time home buyers, 35 and up. Historically in Utah, that was 26. Now we're 35. We had a 10-year gap of first-time home buyers not buying because we had a 10-year gap of builders not building. Nationwide home construction sits around 11 to 14 million over a 10-year period of time, except for 2010 to 2020. When it went down to 7. So we had a $6, $7, $8 million deficit in construction for a 10-year period of time. We're making up for that now. 35 and up with income above that median income. Median income in Salt Lake County is 110, it's 108. I think Davis County's like 110, it's right around that same range. Move up buyers who've been in their home for 6+ years. They've got equity, they got a job, they want to move. They've hated their house for 3. They want out. So you're going to help show them how you can help them get out with a plan. We're going to get a plan in place. And that plan might be when you're ready, you're going to call me and this is what I'm going to help you do. Just make sure you're getting in front of them with the plan. Otherwise, you'll lose that client connection. And then senior homeowners that are in or near retirement. So if you know people that are in that category and you want to create some opportunity to help them and add value to their lives, this could be a really good opportunity to help them and build your business at the same time. How are you going to do that? Number 1, you got to get real intentional, in my opinion, with your connections with your SOI. So your sphere of influence is 75% of your business if you're like any typical agent. Here's my model. If you do this and you don't find success, I will pay for all of your postage. Daily, talk to 5 prospects, 3 existing contacts, and 1 strategic partner. So prospects are people you don't know right now, right? 3 existing contacts, people you know right now. Strategic partner. Who's a strategic partner for you guys? I know one. It could be a lender, it could be a title person, it could be a CPA, it could be a carpet cleaner. I had a conversation this morning with a group and we were talking about who people's target audience was. And the guy who was, he was a physical therapist and he was defining his target audience. And the guy who's the plumber was like, that's exactly who I want to talk to. Awesome. You 2 should be talking, right? Don't limit your strategic partners to real estate. It's people who are talking to your audience. So if you can figure out who you want to talk to, go find people who are talking to those people. And get on their podcast or go and co-market with them or go to their event or whatever it is you're doing to do this. But one of those, and then weekly 5 handwritten notes. The handwritten notes that I have come to like, and I just started doing this, so I'll tell you if it works for me, but it seems like it will, is I was sending out notes, but I was putting my business card in it. As soon as you put a business card in a handwritten note, what did it just become? Marketing. It's a solicitation, right? It's marketing. So I stole this idea from somebody else, but it seems really smart to me. So I'm printing up cards that are like wedding invitation style cards, about that big, one side. And on the bottom of it, it's going to have my email address, my phone number, my name, and my licensing info. And then I can write my note on that card. I can stick it in the envelope. I can hand address, and I can mail it off. It's not my card in there, but if they want to reach me, they can. Well, now it's not marketing. Now it's me just saying, hey, I saw that cool thing on Facebook. Congratulations on, I'm sorry to hear about. Sounds like a cool opportunity, whatever it may be. Does that make sense? So how do you find these 5 new prospects every day? That's going to be hard to do, right? Anybody on LinkedIn? If you want to talk to 35-year-olds that are engineers, CPAs, financial professionals working in IT, you need to be on LinkedIn. You don't have to be like the most active person on LinkedIn, but you need to go familiarize yourself with it and know how to find people. LinkedIn is an amazing prospecting tool. Any data you put it on LinkedIn, you can search. So you could go in, if we connect on LinkedIn, you could go and say, I want to find all of Alan Blood's first connections that are engineers that graduated from Weber State 7 years ago that haven't had a job change in the last 3 years.
Wow.
If somebody's an engineer and they haven't changed their job in the last 3 years, what's happening every day? Recruit, 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 recruit. I talked to somebody yesterday, their son-in-law is an engineer. He just got a job offer that's $50,000 a year more than what he was making with his current employment.
Wow.
Same thing in the IT field, because there's a massive demand for those professions. Those people are not probably going to look at your ad on Facebook or Instagram because they're not there, but they're on LinkedIn because that's their professional communication tool. So that might be a place to go and find some of these people, right? Use your sphere and see who they know. And then if you're looking for my connections, you reach out and go, hey, I noticed you know these 3 people. Would you mind if I connect with them? Would you be willing to introduce me? Would that be okay? And be careful, don't overuse it, right? Go to people you actually know and maybe talk to them and say, hey, this is what I'm trying to do. And by the way, we're strategic partners because we want to talk to the same people. And so if I talk to them, maybe I can help them talk to you too, right? Value added here. You're not going in with your hand out saying, give me more. You're saying, here's how I'm going to help you connect with people you know at the same time. Nobody's going to feel bad about that. Other thing that I would do, then I'm going to stop talking. Niche down. You got to niche down. Pick a niche. Divorce, seniors, first-time home buyers, investors. You could be the neighborhood expert. Pick something. Something that I've learned from some really smart marketing people is you can market down and it's really hard to market up. So let me give you an example. If you position yourself as the expert for all things down payment assistance and grant program related, you know everything there is to know about down payment assistance and grant programs, and you will help people get into homes with no money down because you just know that program and you're awesome at it. Is the person who wants to list their $1 million house going to call you? No, because what did you tell them that you do? Not that. Now, if you position yourself as I help my clients that own homes get into the home they want to be in. And here's my success stories, and here's my tips and tricks, and here's my tools, and here's my methods. And somebody sees, wow, you help these people get from that house to that house. Is it reasonable to infer you could help a first-time home buyer? Probably. Is it reasonable to infer you could maybe help an investor? Probably. So you can kind of pick your niche and then kind of bleed down. It's really hard to market up, is my experience. Does that make sense? So pick your niche, figure out how you want to do it, and then go from there, because then you can really focus your message. And if you want to talk more about picking an avatar, I'd be happy to give you some information on that too. And then last thing, be a farmer. And I'm not talking about send out the 8x8 postcards and you send out postcards 8 times, whatever. You guys know this stuff, right? You've heard it before. Maybe try that, but the statistics on people actually getting their mail right now is terrible. And if they're in a community mailbox, people don't get their mail anymore at all, right? They go through, they rifle through, they find the one bill that was delivered, not ECE delivered, and then they throw everything else away. So that may not be effective unless it looks like a wedding invitation, which is why I'm going that route. So what you might want to do here is go designate an area with a high move up potential. So places where people have been for 3 to 7 or 8 years on average, they have a lot of equity and are maybe kind of getting itchy to move out into the upsized home. And then go be an expert in that neighborhood. Go engage with those people. Maybe there's an HOA. How fun is it to be the HOA president? The best, right? Best job ever? Oh, it's the worst. I would never. Good for you. Service-oriented, James. Well, might there be an HOA president in that area who could really use some professional information from a real estate professional? Maybe you could go find out who the HOA presidents are and say, hey, I know this area really well. I know sometimes issues comes up with HOAs. You guys are trying to make decisions. I've got some great connections in real estate. I'd love to be a resource for you if I can. I can charge. I don't want any money from you. I just know this is something that helps my clients when they have a good managed HOA, and I'd love to help you. Who's going to say no, right? Maybe somebody does. Maybe they're a realtor, but maybe not, right? But it can't hurt to ask. Maybe you're gonna go and you're gonna organize a service activity. There's an agent I know that does a service activity every year in Rose Park. That's where he markets. He doesn't live there. And they go and they pick a house and then he flyers the neighborhood and they get all the neighbors to come out and they clean up this house. Pretty cool. So he's known in that neighborhood as a guy who comes in and helps people clean up their houses. By the way, he puts up signs in the neighborhood as a realtor. Maybe you take your dog for your walk in the neighborhood and you talk to people and have a human communication. If you got a value added item, maybe you could door knock. I like this one. I've shared this for a couple of years. If you do it, let me know. Google is awesome. So go to Google in your area you want to be in, find every business in that area and go post a review. But don't just be like, I went to this business, it was great. You go stand in front, like you were just doing with your phone, and you take a picture of yourself in front of the business. Maybe you run a little video because Google likes video and they're promoting those. Take a picture of the food you ate, and then you write a little narrative about how great it was. And if you're not sure how to write it, go to ChatGPT and it'll write it for you and then make it sound like a human again and post that. And make sure that your Google handle isn't something weird, right? It's something you want to be known as. If it's like James Clark, Big Boy 97 or whatever, that might not be the best. I don't know. I'm just, I mean, just an example. I don't know. It's just a hypothetical. You know, for example, you might go on and say Shana Clark Realtor Pro, right? Maybe use whatever your Instagram handle is, becomes your name on Google. There's a little crow branding here. And then get on every single business. And the more reviews you post on Google, the more people that see your reviews, the higher they rank your reviews and you become a Google guide. And then when you post a review, you go to the top of the stack. So when someone goes, oh, what's a restaurant in Roy? And you've decided Roy's going to be your area. I keep seeing Shane Clark Realtor Pro. Everywhere I look, she's everywhere. And then they see your marketing and they see you at events or they know you. And they go, man, you're everywhere. And you're not in their face. You're just giving them helpful information about a great restaurant. You know, or how much your kids like gymnastics at the studio or whatever it may be. Does that make sense? So you can just kind of guerrilla market your way right in front of every person that's going and looking in that neighborhood. And it's free. It just costs a little bit of time. Lots of strategies you can use. There's a few. Hopefully those will help you as you go through. Lots of information. If you would like any of this, let me know. I'm happy to share it. I did not design this for consumer distribution though. So if you do want a copy, I'm happy to send it to you. Just don't send it out to people. If you want to clip stuff out of it and then put your own stuff on it, do it. I don't care. Awesome. If I can help you guys help your business, that's the reason I'm here. So if you want it, let me know. I'm happy to send you. There you go. That's all I got.
Here's his contact information. If you want to take that QR code really quick, then I'll, or take a screenshot of the image there.
I think that should take you to my Instagram.
Perfect. So I got a lot of comments and things that we could continue talking about this. I took a bunch of notes, but I'm going to skip past that for now. We can talk over lunch because we've got a sponsor in the room. Eric, you want to come up and introduce your sponsor here? Eric brought in a home inspector he really loves to work with to introduce him to all of you. So thanks, Mark, for coming in. Appreciate you.
Thanks for having me.
We got a slide for you too. All hours home inspection right there.
Very nice. Well, guys, I am so excited to introduce you guys to Mark Lacy. Good friend of ours, Michelle and I have known him for years. He's been doing home inspections for us for quite a few years. Yeah, we've done dozens and dozens of properties together, and I'll let him tell himself about the kind of his background, how he got into home inspections. But one thing that I love about Mark is he does a fantastic job with the buyers on the walkthrough after doing an inspection. Makes them feel really comfortable, very thorough, and you know, any positives or negatives about the house, you know. And if you've ever worked with a home inspector and done like 50 inspections and every house closed, you might be using the wrong inspector because they're like making the house look too good. Mark's not afraid to say, hey, this is an issue, right? And we've moved on to some other houses on some of our buyers. So Mark's fantastic about giving really good reviews on the homes and you know, really nice reports afterwards and quick as well. And I don't know if I've ever told this story to you guys or not, but when I first got into real estate 20 years ago, I got this idea that maybe the best way for me to learn about houses is to just tag along with my inspector. So those reviews with the buyers afterwards is how I learned about houses on a really high level and really taking notes. And I learned something with Mark still, you know, about different things on homes. So Mark, tell us a little bit about yourself.
Cool. Thanks for being here. Thanks for lunch, too. Yeah, you're welcome.
So, yeah, I'm a horrible speaker when it comes to groups, so I'm gonna keep it short and sweet. I did want to talk about like what sets me aside from other inspectors. I do have 10 years of construction experience, which so I know homes inside and out. I've got a lot of commercial construction experience. So I do commercial inspections up to 40,000 square feet. I'm working on my master inspectors certification, so it's a pretty big deal. It requires a lot of education, testing, continuing education. And so I've almost achieved that. I also conduct my own sewer scopes. So I know a lot of guys sub that out. I have all my own equipment. So on the agent side, you guys aren't having to let somebody in after the fact that, after the inspector's left or anything like that. So I provide my own sewer scopes. I also do, of course, meth, mold, radon, and I have super access. And my prices are pretty market average, if not kind of at the low end. I like to keep it low just so, people can afford it. And I know how it is to be broke. Also with my reports, I like to customize reports. I know a lot of guys use templates. They'll just see a deficiency, click on it, and it just auto fills the report. But with my reports, I like to at a minimum take a wide shot and a close up, so you have an idea of where it is, and then I create description on every single thing on the spot. So I'm explaining where it is, what it is. Also, in the report, I like to include a lot of links to things to better explain it, because I know a lot of inspectors are scaring people. I know you got to keep them informed, but at the same time, you don't want to scare them. So I like to educate instead of scare. So I'm, a lot of links explaining things. Sometimes if it's something small and minor, I'll include like a YouTube video on how to fix it yourself, things like that. So yeah. Yeah, that was basically it. Do you guys have any questions for me?
Yeah.
What's that? So I'll go all the way to Santa Quinn, North Ogden, Tooele, Park City, no charge. Anywhere beyond that, I charge a drive fee.
Got most of us covered?
Yeah.
I'll go anywhere. And 2,000 square feet and less is $350, and then it's $50 every 1,000 square feet above that. And then I do on every inspection, that's included. Yeah, that's just something that should be done. So yeah, I include that. Yeah, you guys have any other questions?
I'd say it's really nice to have an inspector that does sewer scopes with super access too. I can't tell you how many times I've had to go do the we set up the inspection, and then before, what we do is we meet somebody to do the sewer scope, and they don't have sewer access. They have sewer access. So you're meeting them down there and taking another hour of their time plus drive time. So that's a huge help. Just get it all done in one shot.
Plus, you're not getting someone in that's trying to create a problem in the
True.
sewer.
Yeah.
Super
Sewer scope's 200.
200.
You are the first home inspector I've heard of that does that.
Yeah, I'm internationally certified.
Usually
for sewer
bringing up
scopes,
the plumber.
too, so, yeah, I'm certified for it. And
Super helpful, and you're not trying to replace the sewer line.
exactly. There's no conflict of
You're
interest.
just gonna say this is what you got.
Yeah, here's what it is. And what I do is I run the cable all the way up to the street connection, if that's possible. And then I turn on the video and narrate it as I back it out. So it's a fully narrated video.
What if you
I love
pull the toilet, or will you not do that?
So my insurance doesn't let me pull toilets. I do go in from the roof. It's only happened once in a few years that
It just happened on one of mine, so.
really, yeah. Could they not go through the roof?
They couldn't, they said they had to do the toilet, maybe he could have done through the roof, but
Yeah.
that's what they told me, so.
Yeah, you can go through the roof though. But yeah, my insurance won't let me pull a toilet just because of
all the complications with that and the liability for it, so. Yeah, that's the one thing that stops me, but other than that.
Awesome.
Yeah.
Well, click on his information there and save that. Eric, thanks for bringing him in. I love today. Both Alan was referred by somebody that we know and trust, so there's good recommendation, well, of referrals, right?
Yeah.
So if Eric's bringing Mark into the office. Good to meet you, man.
Yeah, you as well.
Yeah,
There's
appreciate
Cafe Rio out there, you guys, there's tons of it, so.
Awesome. Sorry, you guys on Zoom, go make a sandwich or something. Thanks for sticking to the end though. Love you guys. Reach out if I can do anything for you. And, oh, wait, one more slide. You guys on Zoom too can look at this. We've got some great trainings coming up. Click on that little QR code. It'll take you to our calendar page. Ashley's got about 6 weeks worth of trainings, I think, on there coming up. Next week should be really good if you want to learn how to use social media and increase your audience. So, all right, I'm out. See ya.
Yeah.